Today we're sharing the stock market investment strategy that helped us get to financial independence.
We are self-directed investors who experimented our way to an investment strategy that works for us.
Stick around till the end of the video because we're going to share what we would do differently if we were starting all over again.
A big hello and welcome back to our subscribers. If you're new to our channel, I'm Gillian.
And I'm Stephanie. We're a couple who saved and invested over many years until we finally reached financial independence.
If you're interested in how-tos on financial independence and retiring early, you can hit that subscribe button for more videos.
In our recent video about risk management, which we'll link up in the description below, we shared a little bit about our overall approach to investing. After that video, we received a lot of questions about our investments, so we're going to dig into that in a lot more detail today.
As a quick refresher, our investments are a mix of fixed income and equities. For fixed income, we invest in syndicated mortgages, which provide us with regular interest payments. These are what fund our day-to-day living expenses. For equities, we hold a low-cost global index fund, which gives us a slice of the overall global market.
In today's video, we're going to focus just on our equities, and we're going to talk about what we buy and how and why we buy it.
A quick disclaimer here, we are not investment advisors. We're just sharing our own approach, which suits us and our own risk tolerance.
Before we jump into it, a quick question for everyone who's watching. Do you invest in the stock market? Yes or no? Let us know in the comments below. We would love to hear from you.
True confessions. We were not amazing investors from the get-go. We did a lot of experimentation before finally landing on the strategy that works for us.
We talk more about our history with investing in this video, which explains how we became financially independent. We'll link it up in the description below. So here are a few of the approaches that we have tried over the years.
Like many others, we got our start by buying mutual funds that came along with very high management fees. We had a financial advisor come to our home, he did a quick survey to assess our risk tolerance, and then sold us whatever would be most beneficial for the company he represented. We experimented with investing by sector and trying to time the market. So specifically, we invested in energy ETF after a downturn in that sector and watched it go up and down until we finally sold on an upswing. Now, even though we came out okay, we quickly realized that we were out of our depth and this would be a really good way to lose money.
Then, while we were living in Singapore, we saw that real estate values were going up very quickly and we wanted to get in on the game. So we tried to invest in REITs, real estate investment trusts. And some of these did okay, while a couple of them really tanked. So in the end, what we realized is that we probably needed to be a lot more diversified than investing in a small portfolio of REITs in one small country.
We also had a few other investing ideas that we seriously considered, but thankfully didn't try. For a while, we were thinking of buying individual stocks in emerging industries like 3D printing. This was an industry we knew nothing about, so we were really in no position to be picking out winners. And we're really glad we didn't end up throwing away any of our money on that.
So after a very bumpy journey where we learned a lot, we are now settled on a strategy that really works for us. The first part of our strategy is that we are self-directed DIY investors. This means that we do not work with a financial advisor. Instead, we are responsible and accountable for our own financial planning and our own financial literacy. This also means that we don't invest in anything that we do not understand.
Next, we take a buy and hold approach. When we buy, we're invested for the long haul, meaning a 10-year time horizon or longer. We don't do any panic selling or buying as the markets fluctuate, and we definitely don't try to time the market. I used to try to time the market, but found that our savings would just end up accumulating without getting invested, so I had to get real with myself about that.
On that point, we also made regular contributions. So we would invest the same amount at the same time every month, regardless of the market fluctuations. This approach is called dollar cost averaging, and it really helps to keep your emotions out of the decision making when it comes to investing in the stock market. It also helps average out the price that you're paying for equities over the long term.
Another important part of our strategy is diversification. We know that while individual company stocks can rise and fall, the market as a whole has gone up over time. So we feel the best way to reap the benefits of this rise is by holding as many top performing companies as possible. And this means globally, not just one or two countries.
Now on to what we buy. As you might have guessed by our strategy, we do not buy individual stocks. And the reason for this is because we don't feel that we're in a position to predict the future performance of any one company. Instead, we buy funds composed of thousands of individual stocks. We're also buying index-based funds, meaning that there's no active management picking out the stocks on our behalf and also charging high management fees in the process.
Some investors feel that those fees are worthwhile because active management could yield a higher return. But studies have shown that over time, the returns delivered by these funds have not outweighed the fees. For us, we're satisfied by the average return of the overall market, which is what index-based investing delivers.
So let's talk about exactly which fund we buy and why. Now, there are many funds available. We've selected one that works for us with our particular circumstances. Based on our principle of diversification, we've chosen a fund that benchmarks itself against the FTSE All-World Index. This is a stock market index that covers over 3,000 companies in over 47 countries.
The exact fund that we buy is an exchange-traded fund, or ETF, that trades on the stock market. It's a fund from Vanguard with ticker VWRD, and as mentioned, it tracks the FTSE All-World Index.
US residents who want to buy something similar could look at the Vanguard Total World Stock Index Fund, which is ticker VT. This is just one of many options available, so be sure to look closely at what's right for you.
That's what we buy. Now let's talk about how we buy it. As we said, we're DIY investors, so we manage all our investment accounts directly.
There are many ways to buy index funds like the one we hold. You can use an online brokerage platform like Charles Schwab or Fidelity, or you can even buy direct from Vanguard.
We personally buy our ETFs through an online trading account with Interactive Brokers. This particular platform has a bit of a learning curve and is not for everyone.
We chose Interactive Brokers as our platform because aside from buying equities, we also use it to convert money from one currency to another. And that was really handy for us when we were living in Singapore and earning our salaries in Singapore dollars. Now we'll share what we would do differently with our investing if we could start all over again. And that is to keep it simple and commit to the long term.
We spent too many years tinkering and trying to do better than the market. We tried to time the market and played around with a lot of different investment vehicles.
In fact, a lot of this time was spent just thinking about new strategies and not even taking action. So we ended up sitting on a lot of cash that wasn't working for us making money, just waiting in the bank.
What we have learned is a simple buy and hold approach with a highly diversified portfolio will perform just as well or even better in the long run as compared with tinkering with investments.
If you found this video helpful, we recommend watching the next one right here. It's all about how to manage financial risk. You can go ahead and click on it now.
And if you enjoyed this video, you can let us know by hitting that like button and also subscribe so you don't miss our next video. Thank you so much for watching, and we'll see you back next time.